If you're trading with the wrong style, you'll probably fail. That's why it's so important to know whether you are a scalper, a day trader or a swing trader. In this video, I'll show you the pros and cons of each, and by the end, you'll have a clear idea of which one fits you best. Hi, my name is Matthew and this is Focus Charts. So why does it even matter what type of trader you are? Well, trading isn't one size fits all. If your trading style doesn't match your personality and your lifestyle, it's almost impossible to be consistent. Imagine this. You're someone with a full-time job and limited free time, but you try to scalp on the 1-minute chart. You'll end up stressed, distracted and constantly missing setups. On the other hand, if you're impatient and hate waiting, swing trading will feel extremely slow and you'll probably force trades that aren't there. And that's why it's so important to figure this out early. Finding your trading style isn't about copying what someone else does. It's about aligning the market with you. Once you understand that, everything else, your strategy, your routine, even your mindset will fall into place much more naturally. Here's a quick exercise I really recommend you to do. Take a pen and paper and write down a few things about yourself. First, list your personal traits. Are you impatient? How well can you work under pressure? Write it down. Do you struggle with focus? Or maybe you have trouble making fast decisions? Note all of it, the good and the bad. Do you work a 9-to-5 job? Do you have a family responsibilities or hobbies that take a lot of your time? Write down how much time you realistically have each day to sit in front of the charts, ideally in one focused block without distractions. It doesn't really matter what kind of traits or habits you write down, even if they don't seem related to trading at all. The point is to put everything on paper. Once you have a clear picture of who you are and how your day looks, it will be much easier to figure out which trading style actually fits you. Let's start with scalping. Scalping means taking many trades within a short period of time, usually on a very low time frames like the 1-minute or 5-minute chart. The goal is to capture small price movements, just a few points or ticks, but do it multiple times a day. Let's look at the advantages. You get results quickly. You know within minutes if your trade is a winner or a loser. You don't hold positions overnight, so there's no overnight risk. And if you're someone who loves action, scalping gives you plenty of it. But there are also big downsides. It's extremely stressful. You have to make fast decisions with no hesitation. Even a small mistake can wipe out your gains. Fees, spreads and commissions add up much faster because of the high number of trades. And most importantly, scalping demands full focus. You might be glued to the screen for hours watching every tick. Scalping also usually involves using higher leverage because you try to capture very small and very quick moves in the market. That means if the trade doesn't work out, you'll know within seconds. The question is, can you handle taking a loss that fast and be ready to move on to the next setup with no hesitation? So who is scalping for? It's for traders who have a lot of time to dedicate to the charts, who perform well under pressure and who can stay disciplined even when making split-second decisions. But if you're easily distracted, impatient, or you don't have several hours to sit in front of the charts every day, scalping will probably just burn you out. Now let's move on to day trading. Day trading is the middle ground between scalping and swing trading. Here, you opening and closing trades within the same day, so you're not holding positions overnight. That means you're less exposed to unexpected news or gaps when the market reopens. The advantage of day trading is that you can still catch solid moves without needing to be glued to the screen every second like scalpers do. It gives you more room to analyze, plan your entry and manage your trade. When it comes to risk, day traders usually work with wider stop losses than scalpers, because the trades take longer to play out. And since the stop losses are wider, it naturally means using lower leverage. You don't need extreme leverage to catch these moves, and it helps keep your risk under control. You still need to be very focused during the hours you've chosen to trade. You'll have to make decisions fairly quickly, but not quite as instantly as scalpers. Also, day trading requires you to spend several hours actively monitoring the charts every day, which might not fit everyone's lifestyle. So ask yourself, do you have a few hours each day that you can dedicate fully to trading without distractions? Can you stay focused long enough to wait for the right setups, but also react fast enough when the opportunity comes? And can you handle the mental pressure of closing all trades before the day ends, whether they in profit or loss? But maybe you prefer slower, more patient style. In that case, swing trading could be the answer. Swing trading is all about holding trades for several days, weeks, or sometimes even months. Unlike scalping or day trading, you don't need to sit at your desk all day. Instead, you analyze the bigger picture, place your trades, and let them play out over time. The biggest advantage of swing trading is freedom. You don't have to watch every tick of the market. You can check the charts once or twice a day, manage your positions, and then go live your life. It's often a better fit if you have a full-time job or other commitments, since it doesn't require constant attention. Another plus is that with swing trading, you're usually targeting larger moves on higher time frames. And the higher the time frame, the clearer the picture tends to be. There's less noise compared to lower time frames, which often makes it easier to spot the general direction of the market and increases the probability of being right. But there are also downsides. Swing trading means you'll often have to hold trades overnight, sometimes through weekends, that expose you to gaps, unexpected news, or sudden volatility while you're not watching. Your stop losses also need to be much wider. And while that reduces the stress of micromanaging trades, it also means you likely need to use smaller position size and lower leverage. It also requires a lot of patience. Sometimes you'll be waiting days for a trade to even trigger, and then even more days before you know if it's a winner or a loser. If you're someone who needs quick results, swing trading can feel frustrating. So ask yourself, are you patient enough to wait days or even weeks for your trades to develop? Can you handle the idea of holding positions overnight, knowing the markets could move while you sleep? Does your lifestyle fit better with spending less time at the charts, but committing to longer term trades? So now you know the three main trading styles: scalping, day trading, and swing trading. Each comes with its own advantages and challenges. The most important thing to remember is that there's no one-size-fits-all answer. The best style is the one that matches your personality, your daily routine, and the amount of time you can realistically spend at the charts. Take some time to think about it. Are you more comfortable with fast, intense decisions? Do you prefer a structured day with several trades? Or do you like to step back, analyze the bigger picture, and hold positions for days? Figure that out and you'll already be one step closer to finding your edge in the market. If you found this video helpful, leave a like and share it with someone who's also starting their trading journey. Let me know in the comments which trading style do you think suits you the best, or is it the first time you even thought about it? Okay, thank you so much for watching and stay focused on charts.